Hey everyone, welcome to Lesson 1 Video 2. We're going to be doing a little bit of review from Lesson 1 to see if everything's solidified and we understood everything. So let's get to it, okay? Now in Video 1, we talked about, several different things about a call option. We talked about something called intrinsic value. Intrinsic value. And we talked about extrinsic value, okay? All right, so let's do an example real fast to make sure that we understand this. So if we have, say we have a call option, and let's say that this call option is $90, okay? It's at the $90 strike, the $90 strike price. And let's say that actually let me put here, so we don't get confused, strike price. Now, say that we have a stock, and our stock started trading at $90 and is now trading at $91, okay? Went up $1. 91 stock price, okay? So what do we have here? We know from video 1 that we have gained from our call option that we bought at $90, that the stock price went up to $91, we know that we have gained $1 in intrinsic value, okay? $1 intrinsic value. Now, when we look at our option pricing, remember we took a look at the option chain, we saw different pricing in there, and there were always multiples of this $1, right? It was never just plain $1. It was, sometimes $1.32 or $1.45 or $1.66. Well, where did this other 66 or this other amount come from? Well, we learned from video 1 that this is actually the extrinsic value, okay? And then the extrinsic value, let me circle this part is the extrinsic value, okay, and from our intrinsic value. And from video 1 we learned that this is broken up into 4 different parts, right? We really only talked about 2 different parts, but for completion we will say that it is made up of time decay, or as we know, theta. Let me bump down my font here, really big. Okay, time decay, and we have volatility, or implied volatility, which is known as vega. Remember we talked about the memory devices of V being vega for volatility and T being theta, time decay, right? Let me bump this up. Okay. And we have 2 more, right? That we didn't really talk about. We touched on a little bit, but one is interest rate, or just interest. And this one has to do with the current interest rate, and how much you can actually get paid for having this money in an account versus having it invested in an option. There's a lot of variables to this, but we're not really going to focus on this one too much. And another one that we're not going to focus on too much is the dividend. Okay, this is number 4, and what this has to do, dividend. Is that right? Dividend. Okay. Wow, I don't know. That just doesn't look right for me. But okay, so the other one is the dividend, and this has to do with stocks that are being paid a dividend. All right. What option market makers will do is, if a stock has a dividend, it has it coming up. They factor in this dividend price into the option price. Okay, it's kind of a complex calculation, but like I said, we're not really focused too much on these 2. Okay, what we really want to focus on is the time decay theta, right? and we focused on a lot about the implied volatility. Okay, now there's another part to implied volatility that I want to get into. I know that, you know, the video before I talked about how market makers, they affect implied volatility a lot. Okay, they speculate. They speculate on, you know, future price movement, future volatility, and what's going to happen, you know, sometime in the future, right? There's another side to this implied volatility calculation and another side to how options are priced. Now, this other side goes back to, you know, beginning economics, and it has to do with supply and demand. Okay,